Let's go, folks. Good morning. Welcome to the street today here from Post 35 on the floor of the New York Stock Exchange. It is Thursday, January 26th. I'm your host, JD Durkin. We're about an hour or so into the trading session. Stocks are in green territory right now. The Dow up fractionally, the S&P up 0.5, the NASDAQ up 1% at the moment. Stocks looking here, or at least the Dow rather, looking for a fifth consecutive win in the session. Investors digesting everything from Tesla earnings, IBM, jobless claims, and better than expected GDP as the final piece, the final mosaic of the story that was 2022. The GDP figures are weird, right? The first two quarters kind of down and then kind of shooting right back up there into positive territory. And we're kind of digesting all of that within the last couple of hours. Let's take a look for what is on tap for this morning's broadcast here, my friends. On the show, we will dive into Tesla earnings after the EV giant posted record revenue. Plus, we will be talking the state of the U.S. economy as investors continue to take a look at the latest GDP as well as jobless figures that we got. I wonder if jobless figures were kind of more important than the GDP number. We'll get into that in just a second. And finally, we will tell you why smartphone sales are plunging to a 10-year low. For more on this and so much more, we now welcome in Michelle Schneider. Michelle is the co-owner and manager of MarketGauge.com, and I'm very excited to say she joins me now. Good morning, Michelle. Nice to have you.
Good morning, JD. Nice to see you.
Absolutely. So, of course, one of the big stories here to kick off the trading year, Michelle, has been this big series of these really big rallies here to kick off January. What do you think are some of the biggest factors currently weighing in on investors? Of course, keeping in mind we're still trying to figure out what exactly the newest data points out this morning means. What's top of mind for you?
Well, definitely the market has rallied on some kind of sentiment that the Fed is going to slow down increasing the interest rates, that inflation has peaked, and yet recession, which people now were hoping to avoid with today's data, looks like it will avoid. And all of this, plus, even though earnings have been relatively softer than they have been in a couple of years, there's still been a lot of beats. About 70% have beaten in terms of the S&P. So people are starting to feel cheerful, and I think habitually believe that everything is going to be okay and that the Fed is going to be able to have the soft landing. Of course, we're not quite as optimistic about that as some others.
Why are you not as optimistic as some others, Michelle?
Because I don't believe that inflation has peaked. In fact, I do believe that inflation and commodities in general, by their nature, are volatile, and certainly we've seen that. But if you're just looking here lately at some of the commodities, lumber this morning was a limit up, copper, steel has gone up, gold and silver has gone up, food prices, even though they softened for a while in certain areas, we've got sugar going up, we've got coffee, wheat, corn, soybeans, everything back on the rise. And so we believe that this second wave, possibly super cycle in inflation, and especially in the food and energy and precious metals areas, will actually really come back to bite not only investors, but really put the Fed back into a situation where they have to go back to tightening.
With regards to the overall outlook for 2023, Goldman, as I'm sure you know, put the forecast for the year at only 4,000. As we're having this conversation, the S&P is, where are we at? 4,042. So we're barely a month into the year. Any reason to think that that particular projection may be off? I mean, clearly we basically started the year right at or around 4,000. Not a ton of optimism, at least according to Goldman Sachs, for where we're going to finish the year. But what are your thoughts here as we're a few weeks into the trading year?
Well, basically, we had a target. I wrote an Outlook 2023, and doing the research that we did based on a lot of technical information, we have a 23-month moving average that comes in around 4,200 in the SPX, and that would be the ultimate goal. Also, we have a very key moving average at 3,200, so should things start to slide, we could break down under the recent 3,600 and get back down there. But we really believe that this is going to be a year of a trading range. It could be a wide trading range, obviously, because of all of the new retail investments we've had over the years. But nonetheless, I don't necessarily believe that we're going to go to new highs like many do for exactly what I said, because I really don't believe that people are in reality, in terms of all the layoffs we've had, we haven't seen that hit the job market yet. In terms of the interest rates, which at even capped at 5% can't control certain aspects of inflation. And then on top of that, we still have a lot of government spending, sovereign spending globally, China waking up, definitely some food demand in other countries, particularly where food hoarding can happen, social unrest even in this country. It just seems like there's a whole bag of reasons why we could stay stuck, not necessarily end of days, but really I don't see where we're going to see tremendous growth coming in this year at this point.
As we're having this conversation, we are 6 days out from the next FOMC decision. Of course, we know the Fed has committed to its higher for longer campaign. I wonder your thoughts about a so-called soft landing. Is it wishful thinking, or do you think it's a bit more likely given some of the information that even we've seen in just the last couple of days?
Well, I think basically what we're looking at is trying to fit a square peg into a round hole. We're taking old definitions of recession, inflation, growth, and we're trying to fit it into a very new paradigm. So when they say soft landing, does that mean that we drive into a major recession? Not necessarily, because we have had really, even coming into this definition of recession, not nearly necessarily the way it would be described. Good labor market, housing slowed, but certainly not a 2008 catastrophe. So it's possible that the soft landing means that we don't go into a deep recession. But that's still very, very different than being able to control the type of inflation that is not necessarily easily controllable with interest rates where they were typically until we got like massively accommodative over the last few years.
You mentioned gold a short time ago in your market note, Michelle. You wrote that gold is your main focus at this time. Are commodities overall a bit of a safer play, especially given the volatility that we are seeing in the market and all of these cross currents of uncertainty? And there are a lot of them.
We believe so. We believe that commodities this year will continue to shine. And you can have equities and commodities go up together for a while. But that's really where monetary policy and cool heads at the Fed, and not more what they do is reactive versus proactive, will be very key to see if commodities can be tapered. Otherwise, we think that gold can actually double, possibly even go higher. There's so many different chaotic conditions going on, even in the face of this nice rally that we've enjoyed. So, I always like to mention at this point that macroeconomics are one thing. Obviously, you have to have risk management, but right now the dips are really being bought in the precious metals, in the industrial metals, in the oil market. And as I mentioned at the top, the food and soft commodities really have to be kept an eye on, because if you go back to the 70s, JD, we had an oil peak in 73 with the embargo and the war. Then we had a recession. And then it was really the food commodities that started to go up in 78. And then inflation became more and more out of control because of geopolitics and everything else that was going on in the late 70s. And then we saw that big rally in gold and silver. The difference now is the inflation was just a few countries then. Now we've had more of a global inflation, Australia, record high inflation. So that's why people, I think, are just getting a little too complacent here. And commodities would be the best place, I think, the safest place for this year.
If you're game, I'd love to turn our attention here and talk Tesla. That company posting a beat on earnings, also reporting record revenue for the fourth quarter. We know about the Twitter saga. We know about some of the challenges, especially in China. What were some of your main takeaways from this report that we learned after the close yesterday?
Well, I think the biggest takeaway is that obviously Tesla is not dead, which nobody ever really believed it was. A lot of the sell-off had to do with some public opinion about Elon himself. Obviously, the Twitter situation. He made the book of Guinness, the Guinness Book of World Records in terms of how much wealth he lost so quickly. And now he's gained back a lot of that over the last 50% move from the lows that we've seen in Tesla. But in terms of going forward, I think that's the important thing. And Tesla will obviously always be innovative, as will Elon. But there's a tremendous amount of competition out there. We've been particularly watching even Toyota, because they're coming out with a new Prius. They've come out with a couple of other fully electric cars. It's still the most popular car maker in the United States. And so maybe if China helps Elon along, it can continue to grow from here. But we listened yesterday to a discussion by Tasha Keeney, who works for ARC, looking at $1,500 a share for Tesla by 2026. And I have to say that seems extremely lofty because it's putting it as everybody's going to really be in demand for Tesla. Now, of course, their biggest growth is in the fact that they have software and they have a lot of other things that other companies don't have in terms of the software and in terms of autonomous driving. They're ahead of the game, and they're developing this gigafactory or adding more money to a gigafactory in Nevada. So I'd say Tesla is a strong one and a good barometer for the economy and the market. But I wouldn't necessarily say that it's going to remain the only place to go in terms of looking for investment in the EV space.
Michelle, I wonder if you are on the same page as many who are singing a chorus along the lines that Elon Musk needs to step down from his role at Twitter. It's a distraction. We know the perception with regards to his split attention, but perception drives reality. Or are you of the camp to think, all right, this is a man who has clearly demonstrated against all odds he can run a rocketry company, he can run a brain chip company, he can run an EV company, and yeah, why not? Throw in a social media company on top of it just for good measure. And in doing so, hey, Tesla still does what it needs to do.
I'm actually probably a little bit in both camps, JD. On one level, it is obviously a distraction, and it is a huge nut that he took on without really having a lot of information at his disposal of what it takes to run a big social media company like that. But on the other hand, it is Elon. So everything that you just mentioned just goes to show that he is truly one of the great geniuses of our lifetime. And so I believe that in time, he should be able to work out the cricks in terms of the Twitter space and make that a profitable company again. I know they've lost a lot of money in advertising sales, but I believe in Elon in the longer term, even if sometimes his ego gets in the way.
All right, fair enough. Let's talk some economic data while I still have you here. Weekly jobless claims fell to 186,000 last week. That's not quite what economists were expecting here. The labor market's still pretty hot. What do you make of it, especially, given all these headlines that we're talking about? We know the clearly stated goals of the Fed, but are the numbers kind of going the wrong direction, you think?
Well, again, this is the conundrum of the square peg round hole. This is why for a long time now, I was really very reticent to say anything about recession, because again, if you look at that textbook definition, the labor market has been strong. So this is clearly another indication that we are in a situation that we never really have seen before, where we have contraction and layoffs in certain big corporations, but yet people, after really staying home, going back to work. And also, of course, with inflation, people needing more money while the savings rates go down and the debt goes up in terms of consumer debt. So it's a very interesting place to be. And I think this is the reason why I keep going back to the fact that if things get out of control, if one hole bursts in the dike of everything right now that people are believing is going to be a nice soft landing, easy path to back to growth, new highs in the stock market, I think the labor market is just an indication of saying, well, you can't really go by the old paradigm. 40 years of accommodative Fed is over, and it should be over. So really the question is going to be whether or not those great labor force numbers remain so robust. But the Fed wants to actually see unemployment goosed up a little bit, because that would help them make a determination not to raise so much. So there you go. It's not easy to define right here.
No, of course not, nor is it an enviable task if you're the Fed to try and thread this needle. I wonder, is there ever anything in the overall job conversation that you think doesn't get talked enough about? You follow business news as closely, if not closer than anyone. Do you think there's anything that kind of gets skipped over that you think is, hey, that's pretty important to actually highlight, that you would want our viewers to keep in mind?
Well, there's a couple of things. One, of course, would be the JOLTS number, how many job openings there remain. So far, that has been pretty stubborn at 10, 11 million. So we'll see what happens in the next round of numbers. And the labor participation rate is certainly also interesting. How many people have actually gone back to work? And then, of course, this sort of quiet quitting I find interesting generationally, that people go to work, but they barely actually do their jobs. So all these things are going to be, I think, another addition to what happens as far as how robust the labor market can remain, how many employers out there will actually be able to fill the jobs they need, what impact that might have on supply chain, particularly in the trucking business, where there was an issue with labor. So yeah, there are definitely sticking points to just the 3.5% unemployment rate and everything is wonderful again in this country.
Okay, let me get your perspective here on GDP. We were closely watching to see what would happen for the fourth quarter. We know the story of the first three quarters for last year, but we finally get the piece of the tapestry, so to speak. Expectations at 2.8, it comes in at 2.9. I always like to talk about that Goldilocks zone. Historically, economists like to see it between 2 and 3%, but of course, this is no normal economy, and the goals are not normal for the Fed and for leading economists. So that's the number we get as the final piece of the 2022 puzzle. What does that tell you about the overall state of things? And does it matter very much as we move forward, given that this is a piece of data in the rear view?
Well, it is a piece of data in the rear view, and certainly it is good news. Listen, as an American, you really want to hope that we're going to see economic growth continue, for sure. And 2.9% was encouraging. But then if you step back and you say, in the last few years, we haven't really had any major growth beyond that level. Is that good news, particularly everything else we just talked about, with the dollar potentially declining more, and of course, the inflation rate, which will probably go back up, and maybe possibly more tightening. It goes back to the fact that, yes, good news, but good news has been bad news for the market in the past. And like I said, several times now, we cannot look at things in the same way we've looked at them before because of the fact that we got to this point because of zero interest rates, because of low taxes, because of government spending, because of corporate buybacks of their own stock. And if that all continues, maybe we can continue to see some growth. But you have to say, where's the real growth? And that's where the industrial manufacturing side, particularly looking at the small caps, I think has to participate. And we have not really seen that area participate even since we've seen the rallies starting, let's say, in 2017.
All right, let's wind down this conversation with a little bit of general investing or buying talk here. Of course, we know the territory where stocks have been. Do you see this as a good buying opportunity for people that are looking at the state of things, Michelle, and wondering, I'd love to buy the dip, I just don't know where the dip is?
Well, that was the key last year, right? The dip kept dipping. And so right now we are seeing good dips being bought. Now the question is this rally sustainable? And I think that really is what the investors have to look at with, as you mentioned before, FOMC coming up. The CPI numbers are still really high, even though the PCE was softer. I think that if you are looking to invest right now, if you don't understand commodities, it probably would be a good idea because now you can invest in ETFs very easily. You do not have to be a futures trader, number one. I think fixed income with interest rates is probably still a good area that people can look at. And as far as the overall market, at this point, I would say that if you're not already invested, you might be looking at close to the top with some level of correction. But if the SPX, we mentioned that 4,000 level is key, 3,900, if we can dip back down to there and hold, then I think you can start looking for opportunities in different stocks. Maybe you want to wait a little bit after next week because we have some big earnings coming out with Apple and Amazon, and then we'll see where things are at.
That's right. We got Microsoft really kicking things off with the big tech names a few days ago. We will be following those other names next week very closely. Michelle, what are some of your tried and true investing tips that you are carrying into the new year?
Well, for one is I think people really have to understand that charting matters. Having some kind of a understanding of the major moving averages that all institutional investors use. So it would be the 50 and the 200-day moving average or the 50 and the 200-week moving average. Because if you look classically over the last couple of years, when we broke those, that's when we saw the big decline in 2022. And as we're clearing them is where we're seeing more buying. So I think it's good to have some kind of a navigation system, if you will. The other big tip is really understand your risk reward. People tend to have the opposite type of view when it comes to trading, where they take big losses because they're living on hope. and they take their profits way too quickly because they can't believe they're making money. So a lot of it is really switching that, where you cut your losses really fast when you're wrong and you let your profits run. And I think the retail investor is getting smarter and more active. So my third point would be try not to think so passively unless you're really building a portfolio and you're younger. Try to think more actively, like let me take advantage of things as they are now, because we can see the landscape changes so quickly.
And finally, what are some of the most attractive sectors on Wall Street right now, if any of them are looking attractive to you right now?
Well, everything right now looks attractive, and that's probably the scariest thing of all, because we know that there will be pockets that will remain attractive versus others that might have to go down because of all these things we just talked about, with inflation in particular. So that's why we're really focused. I think no matter what happens right now, precious metals are really going to be the key area to be. There's a place where I'd like to buy dips when we start to see strength being bought robustly, as we're starting to see a little bit now, but still not really at the point where, let's say, we were in the late 70s, then I think we can see parabolic moves in gold and silver in particular. So that's really where I have my keen focus. And of course, the relationship to the dollar, because right now the dollar is not really acting very well, even though it's trying to hold here. Breaks down further, let's say it goes below par with the euro. That could be not so great for our market, but also very good for more of the emerging markets, particularly the commodity-related ones. So these are really where we have our big macro focus.
The great Michelle Schneider. Michelle is co-owner and manager of MarketGauge.com. Thanks a lot for being our special guest today and for all the great perspective and context and helping us all get a little bit smarter together. Michelle, thanks a lot. Enjoy your day.
Thank you so much, JD.